You're watching a Carolina Business Review special presentation in partnership with the Charlotte Chamber of Commerce. Major support for this program provided by Babson Capital Management, a leading global asset manager with over $200 billion in assets under management. Learn more at babsoncapital.com.
In just a short while, all of this space behind us in the Charlotte Convention Center will be filled with seekers and leaders and policy wonks and community advocates and CEOs and press, and in general, those folks that want to be engaged in the important dialogues of the day. I'm Chris William, and welcome to the longest running and the most widely watched source of Carolina business and public policy. And as we celebrate 25 years on the air, we will do so with the most prominent business leaders in Charlotte and the Carolinas in one of the annual conferences that is most prolific in debate. And we start the dialogue now.
This is the 2016 Economic Outlook Conference, featuring Tim Belk, Chairman and CEO, Belk; David Carroll, Senior Executive Vice President, Wells Fargo; Susan DeVore, President and CEO, Premier; Lynn Good, President and CEO, Duke Energy; Jeffrey Lacker, President, Federal Reserve Bank of Richmond; and Brian Moynihan, Chairman and CEO, Bank of America. And now, from the Charlotte Convention Center in Charlotte, North Carolina, your moderator, Chris William.
Welcome. Thank you. I'd take that better if I knew it was authentic, but thank you so much. It's great to have you all here, and certainly thanks to our panel of just outstanding business leaders and opinion leaders. We are coming to you from the Charlotte Convention Center, specifically the Crown Ballroom here in Charlotte above the NASCAR Hall of Fame, and thrilled to have you here. Happy holidays, Happy New Year. Let's get right into it. Mr. Belk, start with you. Wow, big announcement from Belk this year, partnering with Sycamore, but sans that, Tim, when you look back on 2015, what was the most surprising thing about it that surprised you, either with Belk, with the economy, or something else?
Well, the process that we've gone through, probably that was number one. That's been huge for us this year, the journey we've been on, trying to maximize shareholder value and look at that question. And I didn't know whether we would end up staying as an independent company because we felt really good about our prospects for growth, or whether somebody else would put a higher value on that, which is ultimately what happened. So we ended up selling. And we're excited about the road ahead and our new partnership. But I didn't predict that at the beginning.
Yeah, 2015, David, what surprised you most when you look back?
You know, for me, it was the stunning collapse in energy prices and the effect that it had. If 18 months ago someone had told me that oil was going to go from $115 a barrel in the summer of 14 to this morning trading below $35 a barrel, I would have thought it would have been a boon to our economy. And the economists say that it globally added about a half a point to global GDP. And in the U.S., in the short run, it's actually detracted from GDP because of the peripheral industries, steel, transportation, sand, water, and all the fracking. So most people would have thought it would have been a field day, and it's per capita, or it's like $300 a household. So I was surprised by that.
Yeah. Susan, what about you?
You know, I would say that I was surprised by the fact that the Affordable Care Act has neither been the triumph or the tragedy that people predicted. So coverage has been expanded, uninsured rates have come down, people are focusing on changing the way care is delivered, and costs now are increasing, I think, at an even faster rate than people predicted. So I think some of it has worked, some of it hasn't worked so well, but it hasn't been a tragedy or a triumph.
Yeah, well said. What do you think, Madam Chair? What surprised you most about 2015?
So for Duke's business, the biggest surprise was the collapse of emerging markets. In Brazil, building on David's comments just a moment, the low oil prices and the weakness in commodities worldwide has had a big impact around the world, in Brazil in particular, coupled with some issues around Petrobras, has just really stumbled. And so we've had a challenging time in Latin America, and it came on more quickly and more deeply than we anticipated.
Jeffrey, Dr. Lacker, what do you think?
So I think I'd say the slowdown in global growth wasn't fully appreciated at the beginning of the year. I think that's why the other surprise I had is that we didn't raise rates earlier. But I think the reason is global growth stayed our hands for a while. Luckily, the last quarter's worth of data has things looking as if there's a turnaround in trade and things are looking up there. So I think we've stabilized, and I think we're in a good position going forward.
Brian?
I think I'd say you're surprised by the different things that Dr. Lacker and David talked about, but what surprises and Lynn talked about, it surprised me the resiliency. So think about the parade of horribles that occurred out there over the last 12 months since we sat here. We all had the economy predicted a half point to a point faster growth than it will probably turn out to be. I don't think a lot of people had predicted that the first quarter is going to be slightly positive, and originally it was reported negative. I think the world wouldn't have reported the kind of activities that have gone on that are disturbing. The world wouldn't have thought that Brazil was going to fall this fast, this far. Yet the resiliency overall is that the economies of the world continue to be projected to grow, actually did grow, and grew at in the United States, not the pace we wanted, but grew at a reasonable pace for the size of economy. And it's surprising how resilient we are to shake off 2 weeks ago the high yield issues. The world just keeps shaking off this stuff. Now, the question is, are they ignoring it or shaking it off? Right now, it looks like we're shaking it off.
Well, thank you. And let's look forward. 2016. What do you think the opportunities are going to be in 2016? And let's bring it back from the global, even the national, down to the regional, North and South Carolina. Where do you think the opportunity to grow? What do you think the opportunity for a business? Where would they need to be to grow? Is that capital investment? Is that, Tim, do you see, I don't know, maybe stronger consumer buying? Susan, are we back to healthcare? Is that going to be, I mean, anyone at this point, what do you think 2016 is going to kind of, where do we go? What's it going to look like? Dr. Lacker, you want to start?
We're very careful to eschew providing investment advice at the Federal Reserve. But I'll report on what's strong now. I mean, obviously, automotive sector, aerospace, medical equipment, and the like. There are lots of pockets of strength in the manufacturing sector. Obviously, oil and gas, a weak area. Consumer spending has been exceptionally strong, and housing has made very good contributions to growth. Housing investment's been growing faster than GDP overall. So those are the areas, based on past data, one would look to in forming an investment strategy.
Yeah, Brian?
I think you follow up that the piece that's been relatively late to the party here is the jobs impact of housing that it is continuing to build when other areas have gotten weaker. For example, the oil and gas industry laid off a lot of workers early in the year, and it's stabilized. But where it goes next, based on this price, it will be interesting. But the interesting thing people forget is the housing prices are up 5% year over year plus, but the jobs, residential investments continues to go up. And that's a good thing because those jobs are the jobs that are very local. You don't import a house, you don't import a new roof on a house. It has to be done locally, it has to be done by people. And that's why I think you're going to see more, from our experts' viewpoint, you're going to see more positive pressure, i.e. downward pressure on unemployment numbers, pushing it to levels which most of us have never seen, below 5 potentially and beyond. And that is good for America, because that employs a group of people that have been a little slow getting back to work. And you hear from our housing clients, and I'm sure David hears the same thing, they can't get labor, so they're actually holding back on development, which may not be an altogether bad thing because they won't get ahead of it, but they're holding back largely because they can't get the skilled part of the labor set. And if they can get it, then they'll move forward. And so that, I think, is something as you look forward is interesting for next year. Is will housing continue to be a net positive catalyst and offset some of the stuff around oil that you see capital expenditures come down?
David, you want to jump in, and then I'm going to ask you about consumer spending, Tim, after that.
Yeah, picking up on Brian's point, I think you have to keep in mind the resiliency that he mentioned. The economy has kind of worked through some things that 2 or 3 years ago would have been really, really frightening. I'm reasonably bullish about the economy. We always talk about manufacturing, and it truly is important, but it's only 12% of GDP in the United States these days. The services sector is doing great. The consumer's doing well. Housing is doing well. Best auto year on record. Inflation is low. It's just over half of the Fed's long-term target, so we don't really have escalating prices. There was an article in the Journal this morning that said a year ago there were 18 metropolitan areas in the country that had unemployment of less than 3%. There's 31, so we're beginning to see some wage growth, which is a good thing. We haven't had that in a long time. So the services sector, technology, healthcare, I think there's a lot to be pretty bullish about.
Tim, consumer spending, if you looked at just that, would you say we're going in the right direction? We're going to be better off 12 months from now than we are now?
Yeah, we see the trends going in the right way, and I would say 2% is looking like a more solid 2% than it has been in the past, and she's buying more than basics. If you're on the right trends, she'll spend the money. If you have fringe, ponchos, activewear, she'll spend it.
I'd say that the competitiveness of the different, Tim's 100-plus year history in the retailing business, the competitiveness of the different retailing capabilities is, I think, muddles some of the real amount of spending going on, because you have the online merchants capability, you have the different formats, and as you look across our base, the overall spending levels are up 4.5% over last year's December. But you can actually see within that you're seeing this huge shift to the online spending, which is again sprayed out to a lot of brands, but the collective of Amazon and like kinds. And so that whole thing, I think, is muddling people's view, but it's very strong underneath it, that people are spending money, they have more money to spend, they're getting the benefits of gas. That serves our economy, with 2/3 of it driven by the consumer, well, as you look towards next year.
So, Brian, to zoom back out, Lynn, Susan, I want to bring you in on this. To zoom back out, economists will say, listen, this new norm idea that we've been putting out there, it really is. It's not going to be 3.5% GDP growth. So I guess, Lynn, Susan, how do you model, same question, but how do you model your growth based on what you're looking at?
Yeah, so the demand modeling and the growth modeling for healthcare is highly dependent on population growth, aging of the population, demographics, chronic conditions. And the demand for healthcare services is far outpacing the growth in GDP. So it's 1 to 2 to 3% higher than the normal growth rate in GDP, which means that it's a demand for facilities, a demand for healthcare information technology, a demand for drugs, a demand for devices. All of that converts to higher healthcare spending, which federal, state governments and employers are paying for. And so I think we're projecting significant growth, continued implementation of the ACA, and it will create demand in a lot of areas. 62% of our CEOs of health systems across the country say they're increasing capital spending, and 40% would say they're increasing their normal levels by 10% next year.
Lynn?
If you think about the electric sector, maybe 20 years ago, there was a high degree of correlation between GDP growth and the growth in energy. With the introduction of energy efficiency, primarily everything we buy is more efficient than it was what we took out of our homes. That decoupling has occurred. So the growth is really 20% of GDP growth, where at one time it would have been closer to 80% or 100%. And so our challenge is to figure out how to continue delivering outstanding service for customers and modernizing our system when we're expecting low growth. And so the things we look to, we love being in the Southeast because we continue to attract new customers. We like service businesses. And of course, if there is industrial growth in an area, that's extraordinarily helpful. It makes for a great balanced electric system. And so we're constantly looking for ways to drive efficiencies in our business so that we can continue to provide great service at a low cost to customers.
So, Dr. Lacker, we talk about slow growth like it is in passing, that it's temporal. Is slow growth the new status quo? Is this how it's going to be going forward?
So I think a case can be made for that, but I also think a case can be made that we shouldn't be as disappointed about it as you might think. So for one thing, the growth in the working age population is much less than it was in decades past when we became accustomed to 3%, 4%, and 5% GDP growth. So you have to handicap it on that basis. The way we measure productivity growth, measured productivity growth is relatively slow. So we count employment very well, we count the number of hours worked very well, but the actual real value adjusted for quality changes of what people buy, that's very poorly measured. And right now we're going through a period where measured productivity growth is low. Those measures can be revised fairly substantially over time as we get new data, new techniques are used. We experienced this with the whole tech boom in the 90s. After the revisions, the productivity picture was in much better, much more clear view. So I tend to discount the GDP numbers and look at the employment growth. And there, we're getting in growth numbers that are well above the rate we would need to keep pace with the growth in working age population. So I think on that basis, I think we should feel pretty good about this economy and the performance it's turned in since the recession.
One of the ongoing themes has been capital investment, has been deploying cash. Some folks have said, well, the banks aren't lending cash like they were. Tim, capital investment. Are you sitting on more cash than you normally would? And if you can take Sycamore out of the deal, where are you in the cycle about deploying more cash? Where would you make reinvestment? Or what keeps you from doing that right now?
We're in a capital-intensive business with this digital transformation rumbling through retail. It requires heavy investment. It requires you to reinvent your business model. You know, how customers buy, how customers want to receive the things they buy are creating large changes. So that creates a lot of need for capital going into the business.
Back to the bankers. David and Brian, I'd like you both to weigh in on this. A lot of people will say that banks aren't lending the money like they should, like they're making. Is that about a regulatory handcuff? Is that about a lower growth on the rates? First of all, David, I'm assuming you agree with that statement. Do you agree with that statement? And is there a better way to get capital out?
Yes and no. The facts would suggest that bank lending is quite healthy right now. The Fed's most recent numbers are just shy of 8% year over year. By any historical measure, that's a very healthy clip. Another thing, this is more of an economic statistic, but business capital investment tends to run at about 12% over long term, about 12% of the GDP. It's about 12% right now. One thing that's happened since the financial crisis that has absorbed a lot of the investment that otherwise would have gone into things like plant and equipment, we're in a slower growth economy. Business leaders need to see demand before they're going to venture to risk the capital. And since 2009, while the S&P 500 has more than doubled, public companies in this country have bought in about 15% of their market cap. So they're investing kind of in themselves. The best investment opportunity a lot of CFOs and CEOs see is their own company. And so the facts are a little different than the common perception, I think.
Yeah, Brian?
I think that if you look at loan demand, for creditworthy borrowers, as David pointed out, you're seeing good C&I growth across the industry. It's to the point now where people are wondering, is it growing too fast? And that's the inquiry, especially in commercial real estate and areas like that. But we're doing more originations than we've done at any time in the last 7-8 years. The outstandings are growing. And so I think the idea that credit's not available, especially when you go to average middle market company, is they have a line of credit they can draw, and they're still drawing higher than they did, over the last several years, but still sort of on the average of where they've drawn, around 40%. So they could borrow the money if they have an opportunity, and I think it comes more down to what Tim and David are expressing, which is when the opportunity is there, they'll borrow and do it with a slower growth environment and more things that they can see out there to make them nervous, and more global connectivity, which means they have to think about more places. They can't just think about North Carolina. They can't just think about the Southeast. They have to know what's going on in Brazil. They can convince themselves of the demand side movement at any given moment. And I think that has a necessarily conservative effect on them. And so you're seeing that come through, and people are getting more aggressive, and then we give them something to think about. And so I think if we can kind of have a smoother path, I think that you got a pretty sure path to growth that's reasonable. But it's not, I don't see it driven by a credit demand. I mean, I see credit availability for the companies that need credit is out there. The markets are open and doing it. Wouldn't want to be an oil and gas company trying to go to the market right now. But other than that, stuff's going fine.
Yeah, reflecting on the capital-intensive nature of utility business, Lynn, do you get it when, it's not fair to say, Lynn, which I think you'll understand, when people say that companies are not investing like they have in the past? Do you understand that? And how do you take advantage of a low-cost environment for yourself?
So, Chris, we are one of the most capital-intensive industries in the U.S., and in the Carolinas alone, we have over $5 billion of investments that are underway in the form of infrastructure in the state. And what I would say to you is capital investment is something that requires very careful analysis. The changing dynamics, whether it's technologies, whether it's regulation, whether it's customer behavior, whether it's a new commodity that's going to be discovered tomorrow that'll be disruptive to what you're trying to accomplish. You're trying to be thoughtful because capital means I want it to make sense for 10 years. I want it to make sense for a long period of time. So I think the analysis is really important, the thoughtfulness, trying to put it in places that you think will deliver value to your customers, but also be sustainable. I think that's where the hard work is. And when you have a period of uncertainty in any element of your business, I think that makes financially disciplined people thoughtful about how they're going to put that capital to work.
Is Duke deploying capital like you would have deployed capital a decade ago?
I would say we're deploying more capital than we did a decade ago. And if you think about what's going on in the energy industry, complete transformation, whether it's technology to support what customers need and want, or it's the transformation from coal to natural gas to renewables, every element of our business is undergoing change, and capital deployment is necessary to enable all of those technologies. And so we are benefiting from low gas prices, keeps prices low to customers. We're continuing to drive productivity in our business to offset that cost of capital in our customer rates, and that transformation is something we see going on for the next decade.
What capital is, as Dr. Lacker said, is a little bit more, is different than it was in the past. I mean, people think capital, new power plant and stuff. We spend $3 billion on technology a year, developing technology. And that's been fairly consistent. It's probably 3 times the rate we would have spent 10, 15 years ago. And so it's capital investment. It's not capitalized that much of it, but think about how many programs that puts to work. 1 million lines of code or more go in every single weekend except for 2, because we try to take 2 off to give the people. So think about all that. Now, that isn't a plant going up, but that is a consistent amount of investment that's going in. And by the way, we're not unique there. So that's part of the problem of all these measures of what capital is and investment is. When you get into things, intellectual property, technology impact, what that enables a customer to do or what that enables a company to do, the efficiency you get out of it, it is a very different thing than a lot of these measures were built to measure, which was more traditional methods. And so it's going to take a while to shake that out as to what's happened. But what you really know is wages are growing and employment's growing, which at the end of the day is the acid test. If more people work tomorrow in our country than worked yesterday, and they get paid a little bit more or a lot more, that's a good thing. And then the third thing is can we take jobs from everywhere else and have them located here? And that comes down to ingenuity and a lot of other policy structures in low energy costs and things like that. And I think all those things are in America's favor right now. Now, we can blow it, but they're there.
Big sources of capital investment. Appropriate. Big sources of capital investment, Dr. Lacker, certainly come from flow-through earnings. They come from cash on hand, but they also come from debt and leverage. If you look at the balance sheet in this country, about 24 months ago, we had a large debate, an emotional debate, going on about the amount of debt on the country's balance sheet. We haven't talked about that for a while. It's diminished to some degree, but not really. It's somewhere above $4 trillion, and I am a freshman compared to what you know here. But are we going to revisit this idea of too much debt on our balance sheet, and when does it become prohibitive to growth?
So debt's a very useful social contrivance. It's for millennia helped people align their spending with their income more felicitously than they otherwise would be able to do. So debt by itself isn't bad, but debt moderation is important. So there's a lot of different debt out there. I think consumer debt has aligned better with their income prospects, ability to repay, value of their collateral over the last 10 years since the end of the crisis, and I think that's part of what's powering the strength in consumer spending now. The business sector balance sheet looks reasonably healthy. There's a lot of concern about the high yield sector. I think you have sectors that wax and wane from time to time, and at this point I don't see anything that indicates financial distress of a nature that would induce policymakers to come to the rescue of anybody, which is a major tripwire. So I think we're okay there for the time being. But broadly speaking, the business sector looks okay. For the country as a whole, our federal government debt, so we're running at a little over 70% of GDP. That's in a zone that most industrialized economies are able to carry, are able to manage well. But the danger lies at a period starting 5 to 10 years ahead, where that trajectory starts rising and our debt starts growing faster than our income and ability to repay. And at some point, that'll drive us to a point where questions arise about the U.S.'s ability to repay. And I think it's going to force adjustments in our fiscal policy, particularly entitlement programs. And I'm looking at Susan, obviously, in the Medicaid, Medicare sector is going to be required. The sooner we get on that, the better, the less costly the adjustments. And I would hope that dialogue you talked about, Chris, is renewed in the wake of the budget deal we just had, which is going to add to that launching off point. It adds to the debt that we're going to have at that point where things start taking off in 5 or 10 years.
And just a peek behind the curtain at some of the Federal Open Market Committee dialogues, how much does the level of debt in the country play into what the chairwoman or you as a member or other members, your colleagues on the committee, how much does that play into when you talk about interest rate policy?
Well, in my experience on the committee, and it's been over 11 years, I've never heard the interest expense on the federal debt enter into a conversation about interest rate setting. It's the economics of it, it's just not a central concern for us. We're more concerned about the real interest rates, the inflation-adjusted interest rates that consumers and borrowers and banks face, and the incentives that creates and how that aligns with what real interest rate the economy needs. So it doesn't constrain us. And we conduct monetary policy in a way independent of those fiscal pressures, because when you let fiscal pressures influence monetary policy, it's the road to ruin.
Thank you for watching part 1 of the Economic Outlook in the Carolinas. Tune in next week for part 2.
You've been watching the 2016 Economic Outlook Conference, a Carolina Business Review special presentation. For more information, visit carolinabusinessreview.org.